So the tactical income strategy obviously is our longest running track record. It's our flagship product. It's where most of the growth of Hilton has been over the last 20-something years.
Tactical income has been around since the firm's inception. It's the cornerstone of what the firm does.
One of the things that you're taught academically is setting your asset allocation, and this can be for an institutional account or your own portfolio, appropriately for the risk levels you want to take. Obviously, the best performing assets are going to be all equities, but there's a lot of risk that's commensurate with that allocation, and that may be appropriate for some or others. But what's really appealing about tactical income is the framework that it has of trying to keep consistent risk levels, which means that the portfolio shifts with the expectations for the economic outcomes and where the economic cycle is.
The key to its success and why it's continuing to grow the way it is that the investment committee understands that markets are dynamic, not static. We always have to change the way that we're looking at things. We always have to change our analyses and our viewpoints of different situations as the markets go through the cycles.
Our mandate with tactical income is to maintain consistent levels of vol with an emphasis on income and growth as a secondary objective. And fixed income plays a huge role in our portfolios. One, it generates income for the strategy, and two, it provides a volatility dampener when interest rates decline or maybe the economy stumbles.
One of the core advantages of the tactical income strategy is the tactical nature. We spend a great deal of time trying to determine where we are in the economic cycle. Once we determine where we are in the economic cycle, that's going to dictate the level of risk and the allocation of risk throughout the portfolio.
As a firm and personally, it's somewhat predictable how economic cycles work over a longer time frame. And there are times when you want to have more exposure to risk, and there are times when you want to have less exposure to risk. And the way we do it with sort of a multi-year cycle and a longer term framework, this isn't an all or in proposition, but we've done a pretty good job and feel like the strategy is something that a client can hold on to for a long time.
So it's a common thread amongst the three strategies that we're running. It's kind of that protect capital, protect on the downside, but participate on the upside.